Okay, dear students, first of all, welcome to another live revision class for taxation. And student, if you recall, I did give one homework in the previous class, and the homework was very simple. If someone is running a business, number one, but does not have the year end 31st March, then how to deal with that? Okay, that was a homework. Let's start from that homework. And one more thing, students, try to complete all the lectures as soon as possible so that you can have more time for the practice. Assuming examiner gives you the information of Mr. A who runs a business, okay, Mr. Y, let's say, and the data works like that. I'm just assuming, let's say, 1/1/2026 till December 26. We are having a tax adjusted trading loss. Assuming the loss amount is 36,000. Just a minute. It is 36,000. And let's say 1/1/2027 till December 27. We have tax adjusted trading profit. Let's make it 72. This is the information and required. Calculate tax adjusted trading loss / profit for relevant tax years. So student, this is the data which is given to us, and examiner is asking only one thing from us. The question is, whatever information examiner has given you, just actually convert that information. This information is according to the accounting period number one. Second, this time Mr. Y does not have the accounting end 31st March. So that is why the question being asked is, just tell us how much loss, how much profit actually falls in which tax year. Okay. First of all, student, the question information starts from 1/1/2026. Before we convert this accounting period losses as well as profit to tax years, don't forget one very basic concept from where we actually start our taxation. Individual, they pay tax according to tax year, and tax year in UK actually starts from 6th April. Could be any year. Ends on 5th April of the next year. For example, if the tax year starts from 6th April 2025, obviously it's going to end on 5th April 2026. So the tax year actually starts from, basically these two dates are very important for us, simply. First date actually shows the start of the tax year, and the second date actually shows the end of the tax year. Now let's deal with the question. In this question, before 1/1/2026, we do not have any data. The data in this question, information in this question actually starts from 1/1/2026. So what we are going to do, we'll take 1/1/2026. So obviously from here, we'll go to the end of first tax year, which is going to be 5/4/2026. If you count the time period, so I'm having 3 months. And this end of tax year 5th April 2026 actually falls in the tax year 2025-26. How many months we have in the tax year 25-26? 3 months. Now come here. Student, if you look at your accounting period, it is a 12 months accounting period, and the loss is 36,000. But logically, out of this 36, 3,000 loss actually falls in the tax year 25-26. So how will you deal it? We'll take the loss of 36,000, simply 3/12. So 36,000 3/12 I'm getting 9,000 loss. So 25-26 job is done. Now, after 5th April 2026, obviously the next tax year starts from 6th April 2026, ends on 5th April 2027. The tax year is 26-27. Obviously, it's exactly 12 months period. Now, we have just written the dates of tax year. We have to match accounting period months. Students, if you look at the first accounting period of the question, out of these 12 months, logically 9 months they fall in the tax year 26-27. And out of these 12 months, logically 3 months they fall in the tax year 26-27. Repeat, from the first accounting period, 9 months actually fall in the tax year to 26-27, and from the second tax accounting period, 3 months fall in the tax year 26-27, which means that the loss of 36,000, it's a loss of 12 months. Loss of 36,000, it's a loss of 12 months, okay? But for us now, the relevant months are only 9 because 3 months we have already considered. Now, the remaining 3 months profit, we have to take it from here. 72,000, 3 by 12. Obviously, loss and profit automatically they will net off. 36,000, 9 by 12. I'm getting a loss of 27,000. Let's see how much profit we will have. We are having a profit of 18,000. Obviously, automatically they will net off, and you will be having a net loss of 9,000. After that, 6 April 2027 till 5th April 2028, the tax year is 27-28. It's a 12 months account, a 12 months tax year. But now kindly look at this. It is a 12 months accounting period. But can I say out of these 12 months accounting period, 3 months we have already considered in 26-27. Logically, only 9 months they fall in the tax year 27-28. So we'll take 72,000, 9 by 12. So 72,000, 9 by 12. Oh, 9 by 12, my bad. I'm getting 54,000. So logically, the information, the question which examiner is given, from this question, 54,000 is the amount which actually falls in the tax year 27-28. When do we need to perform such calculation? Whenever a student, individual does not keep accounting end 31st March or 5th April. Then we have to perform this sort of calculation. All we need is just convert those tax adjusted trading profit and losses from accounting period to the tax year. But this calculation steps, these are not required if the year end is either 31st March or 5th April. Is that clear, students? When do we need to perform this calculation? Kindly reply in the chat box. Okay, well, it is clear. Whatever others, please. I want everyone to reply before we move to the question. Because this is what we have just discussed. It's a new area in your taxation. And normally new areas are, I would say, chances of new areas to be examined, they are more. Okay, now let's come here, students. It is clear. Thank you. Now, students, look at this question. It's number one, it's a 15 marks question, means from section B. First of all, student, just focus on part A and you should be able to understand what exactly examiner is asking. Calculate trading income, okay. Assessments of SAM, TAM, and UMA. For the tax share, we are just required to calculate trading income of SAM, TAM, and UMA. And all we need is just focus on the tax share 25, 26. So you have to just calculate and tell your examiner that how much of SAM, TAM, and UMA trading profit, trading income actually comes in the tax year 25, 26. That is part A. Part B is asking calculate taxable income of SAM, TAM, and UMA for the tax year 25, 26. Taxable income means after obviously we have deducted the personal allowance. So you will have taxable income. They are not asking us to calculate income tax liability. Sometimes, not every student, but few students, they actually do not stop themselves at taxable income. They go one step, I would say, further, and they end their answer by calculating income tax liability, which is not needed at all because nobody has asked you to calculate income tax liability. And some of the students might give argument, what if I made that mistake, then so what? There's no negative marking. You are making a blunder. You are calculating something which is not required, which means that you are wasting your precious time. So it does not mean if you know something you have to calculate it. They did not ask you. So you have to stop yourself to taxable income. One more thing, you should indicate by use of zero any item which are not. If there's something which is not taxable, not deductible, you have to just write zero. Let's go for part A first, which looks more important. This scenario relates to two requirements. Okay, fine, we have seen that. Sam and Tam have been in partnership since July 2011. Preparing accounts to 30th June. Students, there's a problem. Partnership does not have the year end 31st March. The problem is there. Tam retired as a partner on 31st October 2025. On this date, Tam retired, with Uma replacing her as a partner on 1st November 2025. What is happening on 31st October 25? One partner, the name Tam, is gone, retired. And the new partner, Uma, actually has replaced the Tam. Sam has always received 80% share of the partnership profit, with the Tam and then Uma receiving 20%. When Tam was a partner with the Sam, Tam was getting 20%. When Tam was replaced by Uma, now Uma gets 20%. But every time Sam was getting 80 and Sam still gets 80% of the trading profit of the partnership. Okay. The partnership recent trading profits are as follows. Student, we have got a year end. We are having a year end 30th June 2025. Okay. Then we have a year end this. Now, student, kindly listen to me. First, what we need to do, first we have to actually allocate the given trading profit of the partnership between all these three partners. And after that, we'll see how much each partner's trading profit from the partnership actually falls in the tax year 25, 26. which means that I need a calculator. This is 1,37,500 and the year end is June 25. Part A, one column is for the total. Sam, Tam, Uma. Let me check the year end. Students, the year end is 30th June 25. Okay. Year end is. Now listen to me clearly, please. If you see the question, Tam retired on 31st October. It means till 30th June 25, Tam was a partner. So in the previous accounting period, which is 30th June 25, Tam was a partner. The total partnership profit is 1,37,500. Out of this, 80% actually 1,37,500. Out of this, 80% actually belongs to Sam, which is 1,10,000, and 20% belongs to Tam. I strongly believe that year end 30th June 25 calculation should not be a disturbing factor. Now let's answer. Next one is important. 1st July 2025 till 31st October 25. If you count the time period, these are the 4 months. In the next accounting period, first 4 months, Tam was in partnership with Sam. But how many months? Only 4 months. Now, kindly come here. 1,32,000 is a trading profit of the partnership for the 12 months. First 4 months we have different partners, and the last 8 months we have different partners. Students, I am getting 44,000 and 1,32,000 because last 8 months the partners now they are changed. Last 8 months profit is 88. Now come here. 1,32,000, 4 by 12. It was 44 if I'm not wrong. So students, first 4 months, Sam and we have Tam. Sam obviously 80%, Tam 20. So let's take 80% of 44,000. I'm getting 35,200. 20% of 44,000, I'm getting 8,800. So first 4 months, there are two partners. One is Sam and another is Tam. But student, the remaining 8 months, or you can say the last 8 months, we have got two partners. But this time, out of these two, one is Sam, okay, but the second one is Uma, which means that from 1st November 25 till 30th June 2026, if you count the time period, so we have 8 months. 1,32,000 8 by 12. Let me use a calculator. 1,32,000 8 by 12. Students, I am getting 88,000. 80% of course goes to Sam, which is 70,000. But now students, 20% now will not go to Tam, it will go to Uma. No, which is 17,600. It means that year end 30th June 2026, the total is 1,32,000. Out of this, how much belongs to Sam? It is 105, 600. Tam is 8,800 and Uma is. So far, we have done only one thing. We have just allocated the available trading profits. But obviously, this is not the end of our answer. Now, let's go back to the question and read it nicely what exactly they're asking. Trading assessment of Sam, Tam, Uma for the tax year what? 25, 26. First of all, students, you should know that tax year 25, 26 starts from 6 April 25, ends on 5th April 2026. All you need is, students, just look at your tax year and we will take accounting profit, partnership profit, and convert that according to the tax year. One by one, first let's work on Sam. Sam. Tax year 2025. Now, so just for your understanding, I'm writing something, but you are not required to write this in exam. Okay, please listen. I'm just writing something here just to bring more clarity. But while solving an exam, this step is not required. Which one? I'm just writing in the bracket that I need the accounting profit from 6 April 25 till 5th April 26. Okay. Now come to the question. Student, look at this. 6 April 25 till 30, till 35th. Oh. Till 5th April 26. Look at this. This is a year end. This is a year end. Logically, April 25, May 25, and June 25. Out of these 12 months, logically, 3 months profit falls in the tax year 25, 26. Is that clear, students? The year end is 30th June 2025, but out of this year end 30th June 25, logically, 3 months profit actually falls in the tax year 25, 26, and here the year end is 30th June, and logically we have to stop, you can say, on 31st March 26 or 5th April 26. It's the same thing. So from the second accounting period, students, the matching months which actually fall in the tax year 25, 26, they are 9 months. So from the first accounting period, 3 months actually fall in the tax year 25, 26, and from the second accounting period, students, 9 months they fall in the tax year 25, 26, which means that Sam, and Sam. In case of Sam, we can do this just a minute. 6 April 2025. Now you, if you want, you can write in your answer. Out of this 110, 3 months actually falls in the relevant tax year for which we are solving the question. This is a 12 months tax adjusted accounting, tax adjusted trading profit, which actually belongs to Sam. But out of this 12 months, we only need 9 months. Just a minute. 1,10,000 multiplied by 3 plus 105,600 multiplied by 9. whatever comes divided by 12. Students, I'm getting 106. So basically, trading income, which number one belongs to Sam, second, which actually falls in the tax say 2526 is 106,700. Is that clear, students? Tax adjusted trading profit, which actually falls in the tax rate 2526, and plus which belongs to Sam is 106,700. Now let's go to TAM. TAM, TAM, TAM. Again, the tax rate is obviously same. Okay. Again, TAM from 27,500 profit, 3 months actually fall in the relevant tax year for which we are solving the question. 27,500, 3 by 12. After that, student things they become little bit interesting. How? We have taken 3 months from here. Now listen. After that, TAM stays in the partnership as partner, but only for the next 4 months. Now we do not have a 9 months profit for the TAM. Why we do not have a 9 months profit for the TAM? Because TAM retired from this partnership on 31st October 25. So for us, in the relevant tax year, only the 4 months are relevant relating to TAM, which are 8. The profit is 8,800. No need to do any, I would say, apportionment. So simply 8,800. No need to do any apportionment. Student, that is very important point. Okay. So 27,500, 3 by 12 plus 88. Students, I'm getting 15. Oh, let me write here 15,675. So the partnership trading profit, which number one belongs to TAM, second falls in the next year 25, 26. It is 15,675. Okay. Basically, this 8,800 is a 4 months tax adjusted trading profit. And we need all the 4 months. That is why there's no point of time apportioning if someone does 4 upon 4. You will have 8,800. Now, Uma. Tax year 2025-26. Uma just became a partner in the partnership. Okay. Now, should listen to me carefully. Uma is a partner in the partnership in the last 8 months of current accounting period. Out of these 8 months, last 3 months actually means April 26, May 26, and June 26. Out of these 3 months, they do not fall in the tax year 25, 26. Actually, the remaining 3 months, April complete, May complete, and June complete, the last 3 months actually fall in the tax year 26, 27. So logically, in the tax year 25, 26, out of these 8 months, only 5 months fall in the relevant tax year for which we are solving the question. So it is how much? 17,600. Relevant is only 5 months out of 8. 17,600, 5 upon 8. I'm getting students 11,000. Student, this is part A. Is that clear? Kindly reply. It's a very good question, I'm telling you. Immediately after today's class, those they are obviously right now present online, and those they are watching, I would say, recording of this class, I would request immediately after the class practice this question At least one time, if you can go for two, best. But at least one is minimum. Student, is that clear? Kindly part A is clear to everyone. Let me know so that we can go for part B. I want input from every one of you. So obviously you are here, so you should get the full benefit. Whole answer. Should I show the whole answer? Should I zoom out? This is what you. Student, this is what we have done. Should I zoom out? What exactly? Okay, we have seen that. Okay, now let's go to part B of the question, which looks more important now. Student, again, please read part B. They are asking taxable income. Taxable income means after you have deducted the personal allowance, okay? You are required to calculate taxable income for Sam, Tam, and Uma. Wow. Sam. For the tax year 25-26, Sam does not have any other income apart from 80% share of the partnership profit. So things are very easy as far as Sam is concerned. Thank you, Sam. Taxable income, and the tax year is 25-26. Let's take the trading profit from part A. Sam trading profit from part A is 106. It is 106,700. Less personal allowance, and let me show working one. Actually, whoever is having adjusted net income more than 1 lakh, whoever is having adjusted net income more than 1 lakh, obviously that individual does not get the entire personal allowance. Here, logically, can I say the adjusted net income is 106,700, which means that, let me perform the working here. The personal allowance is 12,570, but due to ANI more than 1 lakh, this personal allowance will be reduced. 106,700 minus 1 lakh. We'll take 50% of this. Students, I am getting 3350. From 12,570, if you deduct 3350, so the remaining personal allowance which is available to Sam is 9,920, which means that taxable income for the Sam, taxable income for the Sam is 97,480. Kindly completely check the working of Sam. Any one of you is having any confusion, kindly ask then and there. Please. If you have any confusion, you are more than welcome to ask. Before we move to the second, I would say, partner. Or if it is clear, then so it's okay then. Kindly reply. Students, I think it is clear to everyone. If it is clear, then let's go to the next one. Next is TAM. TAM, taxable income. Obviously, the tax year is 25-26. First of all, student, from part A, we have to take the trading profit before reading the data. Trading profit, part A. Let's see how much trading profit actually belongs to TAM. It is 15,006. It is actually 15,675. Now let's read the TAM data. TAM. Wow. TAM is a. TAM gives us the more information. In addition to her 20% share of partnership profits, for the tax year 25-26, TAM was employed by XZQ PLC between 6 April to 31st October 25. So she was not only a partner in a partnership firm, along with that, beside that, she was working in XZQ PLC. Simply, she wanted more money. Okay, fine. How many months she worked from 6 April to 31st October? So if you count the time period, April, May, June, July, August, September, October. I've got 7 months. So it means in the tax year 25-26, she received the salary of 7 months and received pension income between 1st November to 5th April 26. Wow, she does not only receive salary, she received the pension income. Excellent. 6 will do this, receive pension income between this. Okay. The following information is available. From 6 April to 31st October 25, TAM receive a monthly salary. Can I say the monthly salary into 7? Is that clear, students? Monthly salary into 7. I hope it should be clear. We are working on TAM's employment income. Salary. What was the salary? 3,400 into 7. I need a calculator. Just a minute. 3,400 into 7. Students, I'm getting 23,800. So in the tax year 25-26, Sam also received the salary of 23,800 from XZQ Limited, PLC, I believe. During the period 6 April to 31st October 25, TAM contributed 5% of her monthly gross salary into XZQ PLC occupational pension scheme. Now stop. Whenever students, please listen, we did this, I would say, this small part so many times earlier as well. Whenever an employee whenever an employee contributes to occupational pension scheme, whenever an employee contributes to occupational pension scheme, it is a deductible expense for the employee. Such contribution reduces employment income of the employee. XGBLC contributed further 10%. Now listen, employers' contribution on the behalf of employees in any of the pension scheme is an exempt benefit. So what her employer contributed That is an exempt benefit for TAM, but what TAM did, that is a deductible expense. So let's go for pension contribution. Wow, wow, wow. TAM was very busy, I believe. Pension contribution by TAM, 23,800 into 5%. Let's see. Students, I'm getting 1190. Pension contribution by employer. That's an exempt benefit. And you have to write zero. Student, it is categorically written in the requirement something which is not deductible and you have to do nothing. But still you have to write zero. If you're not writing zero, you will get marks zero. So now you need to decide. By writing zero, if you're getting 0.5 marks, you should be a happier person. And by not writing zero, you will get 0 marks. So I think getting 0.5 is better than getting zero. So this is the importance of zero. You should realize today that even by writing zero, you can get 0.5 marks. Let's go back to the question. Tam. Okay, the second is done. Okay. TAM has received the pension income also, but examiner did not give us any information of the pension income. Okay. Pension income, of course, a non-saving income, but examiner has not given us any information about the, so far, there's no information about the pension income. XYZ PLC provided TAM with an interest-free loan. Interest-free loan. Students, interest-free loan simply is a beneficial loan to purchase a motorbike. The balance of the loan outstanding was this at the start of the tax year. TAM repaid the loan in full on this date. Now, student, listen to me carefully. If the amount of the beneficial loan, is less than equal to £10,000, it is not exceeding £10,000, then it results in it is an exempt benefit. Otherwise, we know that if it is not an exempt benefit, for example, the amount is more than £10,000 in a tax year, then actually, if you recall, we calculate a taxable benefit by using precise method as well as average, whichever gives us a lower taxable benefit, that is the one which we choose and bring that into the employment income. But here, the loan amount is not exceeding 10,000, so simply it's an exempt benefit. If it is an exempt benefit, you have to write zero. So beneficial loan is there, but actually not resulting in any benefit. Beneficial loan, again, that's an exempt benefit. Okay. Anything else regarding TAM? We do not have. Wow, 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 wow. TAM. Just a minute. That will give us total income of TAM. 15,675 plus 23,800 minus 1190. Okay. Students, I am getting 15,675 plus 23,800 minus 1190. Students, I am getting 38,285. Let's deduct the personal allowance. 12,570. Here comes the taxable income of TAM. Student, taxable income of TAM is 25,715. Wow. So actually, TAM information made us work because they have given us employment income rules as well. So I think TAM information you can also say. TAM information also has given us a little bit revision of employment income. I'm not saying the 100%, but a little bit. Flavor of revision of employment income is there within the information of TAM. Now let's go for the last part, UMA. UMA taxable income 25, 26. First of all, again, we have to take trading profit from part A. Trading profit from part A, part A. Umas. It is 11,000. Uma. By looking, Umas, I would say trading profit. It looks that Uma is not so rich because Uma is having only a trading profit of 11,000. Sam looks so rich. Okay. Let's see other information of Uma. But don't forget one thing, Uma is a new partner. In addition to her 20% share of a partnership profit, Uma was employed by ABCD PLC throughout the tax year 25-26 as a marketing director. The following information is available for the tax year 25-26. Uma was paid a gross annual remuneration of, wow, come on. Uma was paid gross annual director's remuneration of 1 lakh 80,000 by A, B, C, D. My first question to Uma is why you have become a partner in a partnership firm? 180, isn't it enough for you? 180. We thought that Uma is the partner who does not have so much income. We thought Sam is the richest out of these three. I think there's no comparison between Uma and Sam. Wow. 180. Uma. Wow, Uma 1 was getting 180. And she is a director in ABCD. Wow. That's a director's remuneration. Directors, they get paid a lot. You can see the Uma. Wow. Director's remuneration. See, this is what happens when we expect very low marks from one student. Sometimes there's a possibility that a student might turn out to be a position holder. We never know. I think Uma did the same thing. 180. Wow. Let's go back. Uma, we are very impressed from your salary. During the tax year 25-26, Uma paid interest 2100 gross on a personal loan taken out to purchase her shares in a partnership. Student, this is your qualifying loan. And logically, qualifying loan is interest which we pay on a qualifying loan. Interest which we pay on a qualifying loan is deducted from your total income. So, okay. Let us deduct. We do not have any other income. So here comes the total income of Uma. 11,000 plus 180 gives us 1,91,000 less the qualifying interest. Qualifying loan interest paid. Now, student, let me tell you one thing. Where students they make mistake and which area in taxation it really disturbs the students, it's only one area. And name of that area is when you are unable to recall the relevant rule at relevant place. And why it happens? Lack of practice. Why it happens? When you're not revising the rule again and again. Obviously, when you're not revising the rules again and again, then how will you able to recall the relevant rule at relevant place? Not possible. So 1,91,000 minus 2,100 will give us the net income. And the net income is 1,88,900. In the entire question, we did not see that OMA has made any gross personal pension contribution or gross gifted donation, which means that the net income 1,88,900 is also an adjusted net income. Now listen, student. Whoever is having adjusted net income equal to greater than 1,25,140, personal allowance for that individual actually becomes zero. And Uma is the one, does not get any personal allowance because already her adjusted income is more than ANI is more than, in fact. Her ANI is more than 125,140. That is where the personal allowance is actually zero. So here comes the taxable income. So winner out of these three partners is Uma. With a taxable income of 1,88,900, a very good question. I would consider this. I hope students, each and every step of this question is clear to everyone. Kindly reply before we move to the other question. We move to other questions. Let me save this page and share new questions with you. And I would request students, try to take these live revision classes, try to take the benefit from these live revision classes, because these live revision classes, obviously I can understand it's not easy for everyone to come up and attempt the live revision class, but now obviously exams are very near, so try to get the benefit from these live revision classes as much as you can. Okay, dear students, now let's discuss multiple choice questions. And let's see. I think this question is from capital gain tax, CGT. Which two of the following statement about allowable capital losses for an individual are true? The annual exempt amount is deducted before any brought forward capital losses are utilized against the current year gains. True. Basically, we have a disposal proceed minus the cost. Let's say now we are having a gain. Logically, whatever the capital gain comes in the current year, first you need to deduct current year capital loss. After you have deducted current year capital loss, then we deduct annual exempt amount. Let's say 3,000. After deducting the annual exempt amount, if any capital gain is left, then we deduct brought forward capital loss. Why do we do this? There's only one reason. According to HMRC, not me and not you, according to HMRC, while using brought forward capital losses, make sure your annual exempt amount should not be wasted. So then it's okay. If we deduct annual exempt amount before utilizing the brought forward capital loss in this way, we will never waste our annual exempt amount due to brought forward capital losses. So A is perfectly correct. Current year capital losses remaining after offset current year chargeable gains can always be offset against. No, 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 no. Students, capital loss, capital loss can only be set up against the capital gain, not against the income. The annual exempt amount is deducted before any current year capital losses. I think I've just written the format. Disposal proceed cost gives us the gain, then we deduct current year capital loss. After that, annual exempt amount. Excessive current year capital losses are carried forward, yes, indefinitely until the future chargeable gain arises, true. Logically unutilized capital losses will be carried forward and you need to use it in the future when the capital gain comes. So logically, question 134, the answer is A and D. Okay. Let's try question 135. And students, before this class, we have already discussed multiple choice questions on other areas also. Okay. So this is not the first time that we are doing MCQs. We have already done MCQs on other areas as well. What is NOHA's total chargeable gain arising on the sale of two paintings? Okay. Noah sold two paintings at an auction for 14 May 2025 for 4,000 and 7,200, 4,000 respectively. He had purchased two paintings. Wow, wow. Each painting was purchased for £1,000. Student, first of all, of course, it's a question of chattels. Second, it is a non-wasting chattel. Non-wasting chattel means where the predictable life is more than 50 years. Now listen to me carefully. Let's say one is painting one, another is painting two. Now what is happening actually? Obviously, it's a non-wasting chattel. Painting one is actually what is the name of a person? Noah. Noah has bought and sold painting one for less than equal to £6,000. If this is the game, then it is exempt. Repeat. When you bought it and sold it, in fact, not equal, even less than 6,000 it is happening. So obviously it is exempt. Is that clear, students? Here, due to the special 6,000 rule logic, if you ask logically what exactly with the painting one is happening, if you ask that, if you want to be more logical, with painting one, this is happening. We bought and sold for less than 6,000. Otherwise, the rule says if you buy and sell less than equal to 6,000, exempt. So no gain, no loss will arise on painting one. Now let's talk about painting two. Now painting two is having an interesting story. Actually, in painting two, what is happening? The cost is less than 6, but we sold it for more than 6. So when cost of your non-wasting chattel is less than 6, but you manage to sold it for over 6, then obviously you have to calculate capital gain in two ways. One, a normal calculation means disposal proceed minus cost, and then we have to calculate the capital gain by using a formula. Whichever results in a lower capital gain, that is going to be your gain. So let's try on painting 2. First, let us on painting 2 simply calculate the capital gain. Disposal proceed of painting 2 is 7,200 and obviously the cost is 1,000. So painting 2 is having a chargeable gain 6,200, but this will be compared with a chargeable gain. Simply the gain is equal to gross sale proceed, which is 7,200 minus 6,000 into 5 by 3. Students, I am having 2,000. So logically 6,200 and 2,000, whichever gives you the lower result, that is your chargeable gain, that is your capital gain. So which is 2,000. So I would consider this question 135 very good question, because at times it becomes difficult for the student to quickly recall the 6,000 special rule. But again, those students with a very good practice and with a very good revision, for them it is easy to revise. Otherwise, of course, nothing is easy in this world. Okay, let's go to next question. What is Lime's allowable loss on this disposal? So one thing is for sure, they're asking loss. So make sure you should end your answer by calculating a loss rather than you come up with a gain. Then we have to put one more option that given all options are incorrect, actually there's no loss, we are getting a gain. So make sure you should get a loss. Liam purchase an antique glass vase for 22,000. Wow. On 30th March 2009, incur a legal fee of 800. So that is also a part of purchase cost. So logically, this vase cost is not 22,000 for you. It is logically 22,000 plus that 800. Okay. The market for the antique glassware has since slumped, and Liam sold it for just 5,500. Now stop. Now what is happening here? Again, this vase is a non-wasting chattel. Okay. You bought it for more than 6, but you are selling it for less than 6. If you bought it for more than 6, sold it for less than 6, in that case, we assume that your disposal proceed is £6,000. Repeat. If a non-wasting chattel was bought for more than 6 and you sold it for less than 6, then we assume your disposal proceed is 6,000. Auctioneer fee is incidental selling cost, which is an allowable cost. So look at this. Disposal proceed as students we assume, okay, is £6,000. We will deduct this selling cost, which is 300. So the net disposal proceed is 5,700. From this 5,700, we'll deduct logically 22,000 plus 800. So simply we will deduct the total cost 22,000 plus the legal cost which incurred while we were purchasing it. It is 22,800. So at least we are getting a capital loss. That is a good part. Either it matches out of these four choices and with any one or not, that's a separate thing. 5,700 minus 22,800. 5,700 minus 22,800. Students, I am getting a capital loss of 17,100. Kindly check. Do we have any option? Oh, yes. So we have the option. Students, you can see that. Answer is Charlie. Otherwise, we know that for most of the students, if they do not get answer, for them, the favorite, I would say, favorite choice is Charlie, or either it is Charlie or Delta. But right now, student, it is Charlie. Let's go to question 137. Wow. What amount of capital losses can NOG carry forward? For the tax say 26-27. So we have to calculate capital losses carry forward for next tax year. Okay. For the tax say 25-26, NOG has a chargeable gain 17,400. We are having a chargeable gain 17,400. Capital loss 10,100. Student, we did discuss current year capital gain first minus the current year capital loss. Current year capital loss. Current year capital loss is 10,100. Now we will deduct annual exempt amount. Whatever comes against that remaining gain, we will utilize brought forward capital losses. This is the simple format which we have to follow. Student, we still have a chargeable gain of 4,300. So the maximum brought forward capital loss can be utilized as 4,300. We are having a loss of 5,300, which means that Out of this 5,300, we can maximum use this. So logically, brought forward capital loss, we had 5,300. We have used this much. So can I say 1,000 is carry forward? Is that clear, students? The carry forward capital loss is 1,000. And to be more precise, that 1,000 is logically coming from that brought forward capital loss. Nothing is being carried forward from the current year capital loss because it is already utilized. And the rule, obviously, the rule says first we have to utilize current year capital loss, then annual exempt amount. After that, we will see if we have any brought forward capital loss. If yes, then we have to decide how much we can use it. So it is carried forward 1,000, and logically it is coming because of that brought forward capital loss. Wow. What is what is Jessica's chargeable gain in respect of disposal of copyright, other wasting assets? Students, if you recall the normal lecture, we did discuss if you come across any other wasting asset question, then examiner will give you the useful life of that asset. Whenever the useful life of that asset is given to you, all you need is from the disposal proceed, you need to deduct net book value. On 31st March 2026, Jessica sold a copyright for 28,800. So at least we know the sale proceed. Sale proceed is 28,800. Okay. The copyright had been purchased on 1st April 2020 for 21,000 when it had an unexpired life 15 years. The day we bought copyright, at that time the life was 15 years. Remaining life was 15. Now simply you need to deduct, I would say, if I just bring little bit accounting, net book value 21,000. First of all, multiply this with a total life. Then on the numerator, just write the remaining life. At the time of disposal, what is the remaining life? Okay, now let's see how many years already they have gone. If you count the time period from April 22, so basically from here, if I count, then I'll go for 21, 22, 23, 24, 25. Basically, 5 years have been passed. Kindly check, students. In fact, we have to go till 26. So 6 years have been passed. Why? 21, 22, 23, 24, 25, and 26. So can I say this? At the time of disposal, 6 years we have utilized the copyrights, which means that remaining life at the time of disposal is only 9 years. Is that clear? You can count from 21, 22, 23, 24, 25, and 26. So logically, the remaining life is 9 years. So 21,000 multiplied by 9 upon 15, I am getting, students, 12,600. So here comes the chargeable gain, which is 16,000. The chargeable gain is 16,200. Let's go ahead. Oh. Identify AI. Identify Eden's chargeable gain. Chargeable gain 1. Due date for the capital gain tax payable thereon. Students, if you read the requirement slow and nice, You will see. Examiner is not asking us one thing. Examiner is asking two things. So yeah, nowadays examiner they are expecting a lot from us. They're not expecting anything from you kindly. Read the question nice and slow. Chargeable gain number one and the due date. Other than disposal of residential properties. What did I say? Other than disposal of residential properties, we make the payment of capital gain tax on 31st January after the end of the tax year. If we have sold the residential property during the tax year, when it comes to residential properties, then residential properties CGT is paid within 60 days from the disposal. And that CGT on residential property capital gain is treated as a payment on account. Again, a quick revision. AI bought 30 hectares of land for 30,000. Student, look at this data. Hectares. Normally, this is an indication of a part disposal. The issue of part disposal arises when you are selling a portion of a larger asset. 30 hectares of land, they were bought for 3 lakh. On 1st March 2020, sold 10 hectares of land for 150. Out of 30, 10 they have already sold the way back. At this time, the remaining land worth 250. In January 26, which actually falls in the tax year 25-26, Aden sold the remaining hectare for 4,25,600. So it looks very easy. Come here. Disposal proceed is 4,25,600. Let us simply deduct allowable cost. Then the question is how to calculate allowable cost. It is up to you how you calculate. Let me tell you. Come here. Original cost is 3 lakh. Number one. Number two. 10 hectares they were sold earlier. Disposal proceed of 10 hectares is 150. Market value at the time of disposal of 10 hectares for the remaining hectare was 250. So I can directly calculate how much cost out of 3 lakh belongs to that remaining 20 hectares. Look at this. If we take 300,000, you multiply this with the market value of the part which you are selling right now. Market value of the part which you are selling right now divided by 4 lakh. How did I get this 4 lakh? 150 plus 250. That will directly give you the cost of the part which you are selling right now. Otherwise, I'll show you. There's one more presentation. I'm getting 1,87,500. If someone does not like this presentation, no issue at all. I'll show you another presentation is also available. I was just giving you another out of box idea. Something which is not a traditional approach of solving this question. 425,600. Students, I'm getting 2 lakh. 38,100. That's a chargeable gain. So chargeable gain is 2,38,100. And obviously we will be making payment. We are selling this. We are selling this on 1st January 26. 1st January 26 means we are selling this in the tax year 25-26. So the other than residential property, whatever the capital gain comes, CGT is paid on 31st January after the end of the tax year. So can I say the relevant date is 31st January 2027 and chargeable amount is 2,38,100. So the option D. For 1,39,000, relevant answer is option D. Now let me show you another way of calculating the same answer, which is a more traditional approach, which majority of the students they actually follow. Majority of the student, they solve this question from the first portion when it was sold. Actually, when 10 hectares were sold for 150, so the first time when the part disposal formula was used, 300,000 into disposal proceed divided by disposal proceed plus the market value of the remaining part. Three hundred thousand 150 upon 400. So initially, the 10 hectares when we sold, this is the cost 1,12,500, which actually belongs to the 10 hectare we have sold. Now, what is the cost for the remaining 20 hectares? Just take the difference of these two. 3 lakh minus 1,12,500. Obviously, you will get 187. Now, from the disposal proceed, if you deduct 187,500, obviously you will get the same answer. Now, it is obviously purely up to the student either to follow the first approach or to follow the second, more traditional approach. It is up to you. Okay, just a minute. Let's go to question 140. What is Habib's chargeable gain or allowable loss? Now they're not telling us either it's going to be gain. They're saying either it could be gain or could be loss. For the tax year 25-26 in respect of disposal of copyrights, other wasting asset. How do we calculate capital gain or loss on other wasting asset? From the disposal proceed, you just need to deduct net book value. Habib purchased a copyright. This is the purchase cost. April 2009 for 31,320. The remaining life of the copyright at the date of purchase was 30 years. On 30th April 2025, Habib sold the copyright. So the disposal proceed is 27,900. How will you calculate allowable cost? Take 31,320 multiply by remaining life upon total life. All you need is just to calculate the remaining life. So if you count the time period from 2025, if I deduct 2209, I'll get 16 years. Logically, 16 years have been passed out of 30. I've taken the difference of only two dates, the date of purchase and date of sold. It has given me the exactly 16 years. There's no months. Examiner does not go into that much, I would say, so much minute calculation. Examiner does not go. Normally, you will have the information on the basis of years. So at the date of disposal, 16 years were passed. So the remaining life is 14 years. So 31,320 multiplied by 14 upon 30. Students, I'm getting 14,616. So we are getting a capital gain. Chargeable gain is 13,000. Chargeable gain is 13,284. Okay. Let's see the next part. Assuming that as far as possible, Lotte claims to defer any chargeable gains arising in the tax year 25-26. Okay. Calculate the carried forward base cost of the new warehouse purchased on January 2026. Let's read it again. Assume as far as possible, Lotte claims to defer any chargeable gains arising in the tax year 25-26. Let's see the question. Lotte purchased a freehold warehouse on 20th November 2020 for 52,000. On 30th June 2025, the warehouse was destroyed in a fire. August 25, Lotte received an insurance proceeds 71,000. Student, one concept we have already discussed in our regular classes. There is a possibility That asset was destroyed in a different tax year and insurance proceed was received in a different tax year. Logically, all the calculation, everything starts the day you receive the insurance proceed. So for us, the more relevant tax year is the year in which we have received the insurance proceed. Okay. So Lotte received the insurance proceeds 71,000. She spent 64,000 of the proceed on a replacement warehouse on 29 Jan 2026. Okay, fine. Now what they are asking us, assuming as far as possible Lotte defers. Now listen, Sean, what is actually happening? Insurance proceed is 71, but the reinvestment is less than that. It's a partial reinvestment. Now, student, if you recall, in partial reinvestment case, actually what happens? The chargeable gain is lower of gain itself, and the second is amount not reinvested. So we are facing a scenario of partial reinvestment where chargeable gain is lower of, number one is the gain, number two, amount not invested. Okay, fine. Now logically, insurance proceed is treated as a sale proceed. So from 71,000, we'll deduct the cost 52. That actually gives us the gain 19,000. So we are having a gain 19, but we are not reinvesting the entire amount. 71 is the insurance proceed, but the investment is 64. So logically, how much we are not reinvesting? Students, 7,000 we are not reinvesting. Now listen to me carefully. Logically, the gain amount is 19, but out of that 19, 7,000 becomes chargeable. If the 7,000 becomes chargeable, then logically your deferred relief is only 12,000, the difference of gain and the chargeable gain. Repeat, the question which we are dealing right now, it's a partial reinvestment case in which the HMRC says chargeable gain is lower of gain itself and the second amount not reinvested. The gain is 19, amount not reinvested is 7, which means gain is 19. Logically, we have now calculated out of that chargeable gain should be 7. If the chargeable gain is 7, then rollover relief, deferred relief is, your deferred gain is 12,000. And this deferred gain will be deducted from the base cost of replaced asset. This deferred gain, rollover relief you can say, is deducted from the cost of replacement asset. Replacement asset is bought for 64,000. So new warehouse purchase for 64 less this deferred gain, 12,000. So we are having a base cost of 52,000. So what they have asked us, we have calculated many things, assuming that as far as possible, law claims the to defer any chargeable gain arising in the tax year 25-26, calculate carried forward base cost. So the base cost is 52,000. But it's a very good question. Mainly this question based on a concept, on a rule which is, I would say, partial reinvestment. Okay. And the rule of partial reinvestment says gain, chargeable gain is lower of gain itself and amount not reinvested. Now let's try this 142. What is the base cost of restored freehold property for capital gain tax purposes? On 10 January 2026, a freehold property owned by a Winifred was damaged by a fire. The property had been purchased on 29 May 2012 for 73,000. Winifred received an insurance proceed 37,200 on 23rd Feb 2026. She spent total 41,700 during the March restoring the property. Winifred has elected to disregard. It's not a part. She's not going for a part disposal. So all you need is just calculate the new base cost. So it's very simple to calculate. First, we have to take the original cost, which is 73,000. Then you can simply add whatever amount she has spent on restoring, which is 47,700, 41,700, and minus the insurance proceed, which is 37,200. So that will give us a revised base cost, which is 77,500. Original cost plus the amount spent on restoration less insurance proceed will give us the revised base cost. Now, let's see this one. What is the chargeable gain on the gift of 10,000 shares? Wow. Chargeable gain on the gift of 10,000 shares. Madison gave 10,000 shares in Miles PLC to her daughter during the tax year 25-26. Great. The shares were quoted in the stock exchange. Official rate is this per share on a day of the sale. Madison acquired 15,000 shares in Milestone for this. Now listen, student, carefully. One, it is capital gain tax. Second, we are providing a gift. And obviously, shares are the quoted shares. An examiner has given us two list prices. So in that case, we have to work on average price to calculate the market value. Another point, whenever we are providing a gift of anything to our connected person, the number one, according to HMRC, it is treated as a disposal proceed. And disposal proceed is actually equal to the market value of that asset. So first we have to calculate the market value of these shares, which is treated as a disposal proceed. Then we'll deduct the original cost. Difference is going to be a capital gain. So basically we have got 120 and 136 pence. So I'll take it 1.2 pounds plus 1.36 pounds divided by 2. That will give us average 1.28. So the market price of each share is 1.28, which means that you can say that is disposal proceed, which we assume. The market value is the disposal proceed 10,000 into 1.28. The market value of these shares which are given as gift is 12,800 less the cost. Father purchased 15,000 shares for 4,000 pounds. Out of 15, 10,000 are given as gift. So we are getting 2,667. The difference is the chargeable gain. Just a minute. So in chargeable gain, I'm having 10,133. Okay. Now let's try question 144. What is Clarissa? Total chargeable gain for these disposal in the tax year 25-26. What is Clarissa? New name? Clarissa has, maybe for me, not for everyone. Clarissa has disposed of the following shares and securities during the tax year. Guild government bonds for 8,000 which were purchased for this exempt. disposal of government bond is an exempt asset. 20,000 shares in Martin PLC sold to her sister for what? 7,000. Stop. When you are selling any asset to your connected person, then normally we sell at a lower than the market value. Then according to HMRC, no matter whatever you are charging to your connected person, basically we will take the market value as the disposal proceed. Market value of the shares on the day of sale was 12,300. So for us, we will assume disposal proceed at 12,300. Cost is 8, which means that disposal proceed, we will assume 12,300, and they bought it for 8 less the cost. Simply capital gain is 4,300. The capital gain is simply 4,300. Okay, now let's deal with this question. Select the share purchases which will be matched to the 20,000 shares sold on 1st October 25. Now, recall the matching order for individual. For individual, the matching order says first you sell the shares which you have bought on the same day of disposal. Repeat. Step one, actually, we sell the shares which we bought on the same day of disposal. Number one. Number two is the shares which you purchase in the next 30 days of the disposal. And the last one is shares in the pool, all those shares which you bought before the day of disposal. Repeat. What is the sequence in matching order is? First, we sell the shares which we bought on the same day of disposal. Second, we sell those shares which we bought in the next 30 days of the disposal. And the last one, the shares which are coming from the pool, all those shares which were purchased before the day of disposal, they are in the pool. So first we'll be selling the same day purchases, then the following 30 days purchases, then shares from the pool. Emily had the following transaction in the shares of Elijah PLC during 25. 1st June purchased 22,000 shares. October purchased 2,000. Oh, she sold 20,000 shares were sold on 1st October. Look at this. 23rd October she purchased 3,000. Now listen. Logically, student, 1st October. This 2,000 has to be first. Match the first. So can I, the first one is 2,000? And logically, we bought on 1st October. Is that clear, students? Now in the next 30 days, 3,000. Is that clear, students? Purchase on 23rd October. Now listen, student. All those shares, all the remaining shares, they are coming from the pool which you have, the shares which you have in the pool on 1st October. Let's see. Number one, we have got obviously these 22,000 shares, they are in the pool. So we'll take 15,000 shares. We'll take these 15,000 shares obviously from the pool, but logically, when we solve the question, then you will be preparing a pool and you will have to see on 1st October till the day of 1st October, whatever is the year, how many shares they are in the pool. So 15,000 shares we'll take from the pool. As at 1st October. Because we are selling on 1st October. Are you getting the point? I cannot sit in a time machine and go back and say, okay, I'm selling on 1st June. How can you go back? So it is as at 1st October. So these are the answers. I don't know. Do we have these choices? We have just written this 15,000 from this is the third one. This 2,000 is the first one, and this is the second one. I hope this is the case. Kindly check. First, we sold 2,000 shares on 1st October, the day of sold. We bought the purchaser shares. Then next 30 days, and then shares in the pool. Okay. Student, read this question. Let me drink water. Let's see who is giving the answer. What is the capital gain tax liability? Okay. Arising on the disposal of shares in February 2026, assuming all available reliefs are claimed, and Sia Bahan makes no other disposal in the tax year 25-26. Okay. Feb 26, 2026, Sia CO Bahan, a higher rate taxpayer, sold shares in Banana Limited, a trading company. She realized the gain of 36,000. Sia Sayo Bahan, I believe. Sayo Bahan acquired newly issued shares in July 2022. So time period is more than 3 years. Sayo Bahan has never worked at Banana, nor has she made any previous share disposal. So student, you should be thinking for investor relief. Basically, badder is available when you are selling shares in a personal trading company. You need to have, for the badder, you need to have a 2 years ownership period, but you should be part-time, full-time employee of that company. Plus your holding has to be 5%. But in case of investor relief, you should not be the employee of that company, which is the case here. And you should subscribe those shares, plus ownership period has to be 3 years. So everything is fulfilled. You will be getting the investor relief, and where investor relief is applicable, then CGT rate is going to be 14%. So from this 36,000 chargeable gain, we'll deduct the annual exempt amount, which is 3,000. That gives us the taxable gain 33,000. On this 33, student, we'll apply 14% investor relief percentage. So 33,000, 14% of 33,000, I'm getting 4,620. 4,620. Okay. Wow, wow, wow. That looks a big question to me. Identify the allowable cost for capital gain tax purposes for the shares disposal on 25th March 2026 and due date for the capital gain tax payable. Student, read it. Allow one thing they are asking us to calculate this time allowable cost plus the due date of CGT. Now listen, student. Other than residential property, we pay CGT on 31st January after the end of the tax year. Okay, let's read the question. Caleb had the following transaction in Harper PLC share. 26 April 2014, purchase 40,000 shares in Harper PLC for 260. Okay. 19 May 2017, Harper PLC announced 1 for 4 right issue for £4 per share. Caleb took up all the right. 3rd May 2021, Harper PLC announced 1 for 5 bonus issue. On this day, they have sold 12,500 shares were sold, but this time they're asking us to calculate allowable cost for the 12,500 shares. Student, I can't see any shares which were bought on this day of disposal. I can't see any shares which were bought in the next 30 days of the disposal. Logically, all the 12,500 shares, they were sold from the pool. So actually, we have to first prepare the pool, and then from pool we will calculate the 12,500 shares cost. So let's start. And all those shares which individual is having before the day of disposal, obviously in the same company, they are a part of pool. And you will start making the pool from very first transaction. Let's say number, cost. So 26 April 2014. So simply, uh 2014 April, purchase. How many shares were purchased? 40,000 for 40,000 shares for 260. Then there was a right issue, 19 May simply 2017. Student, right issue was 1 for 4 means 40,000 shares before the right. 1 upon 4 means the number of right which Caleb took, they are 10,000. And one right was given to Caleb for pound 4, which means right issue costed Caleb 40,000 pounds. After that, there's a bonus issue. We know that in case of bonus issue, number of shares will increase, but total cost will remain same. 145, it is May 2021. So simply 2021. We have a bonus issue. Now listen, student. Before the bonus issue, total number of shares are 50,000. 40 and 10. Repeat. Before the bonus issue, total number of shares we have 50. And the bonus issue form is 1 against 5, which means the total number of bonus there are 10,000. Obviously, no cost. So the total number of shares before the disposal, Caleb had 60,000. Cost is 3 lakh. How many of them he has sold? 12,500. So simply disposal 12,500. Now we need to calculate allowable cost of 12,500 shares. Very easily we can calculate. The remaining shares are 47,500. So simply 300,000 divided by 60 will give us the average cost per share. How many shares are sold? 12,500. So 3 lakh divided by 60,000. Student, I'm getting 62,500. Logically, allowable cost for 12,500 shares is 62,500. Okay. So allowable cost is this one. And he's selling on 25th March 26 means tax year 25-26. And we know that the tax year 25-26, other than the residential property, what on any asset, other than that, whatever the capital gain comes, we pay CGT on 31st January after the end of tax year. So student, the right choice is beta. The right choice is beta. Let's see question 148. What is Hunter's chargeable gain as a result of takeover? Hunter purchased 50,000 shares in Grayson Limited for 90,000 pound on 30th May 2014. What Hunter did in the past, he bought 50,000 shares in Grayson for 90,000 pound. On 1st November 2025, Grayson Limited was taken over by Relay PLC. Grayson Limited shareholders received £3 cash and 2 Relay PLC ordinary shares, two, for £1 share for every Grayson Limited shares. Immediately after the takeover, Relay PLC share worth was 1.2. Now listen, student. What is actually happening? Hunter was a shareholder of Grayson. This Grayson company was taken over by Relay PLC, and obviously Hunter has received cash as well as ordinary share in the new company. Now, how to deal with this scenario of takeover? First of all, student, we'll see we need to know the market value of the consideration received. Second, previous shares cost will be allocated according to the market value of the consideration received. And second, there will be a capital gain which we will calculate but only against the cash consideration which we have received. So let's deal with this. Market value of consideration, and we will allocate the old cost. Cash, Hunter has received £3 against each share. So the total cash received was 1,50,000. He has also received 2 shares against each share. 50,000 shares against each share. Hunter has received 2 shares in Relay, and you have to calculate the market value of the Relay shares. The market value immediately after takeover is 1.2. So market value of the shares in Relay is 120. So the total consideration market value is 270. Previous share cost is 90,000. Logically, this 90 will be allocated to the cash consideration and the market and the share consideration. Take this 90,000, divide by 270, multiply by 150. So 90,000 divided by 270 multiply by 150. Students, I'm getting 50,000. Kindly check every one of you. Obviously, if here we are getting 50, then here it has to be 40. A balancing figure. So simply, how will you calculate chargeable gain? Disposal proceed, we assume the cash which we have received, we assume it is a disposal proceed minus the cost which we have allocated, which is 50,000. So student, the chargeable gain is 1 lakh. And student, let me tell you one thing. If it is a scenario of reorganization or a takeover, tax implications are same, only the concept is different. In case of takeover, what happens? Obviously, you become a shareholder of another company. In case of reorganization, you will remain the shareholder of the same company. Only the shareholding proposition will change. For example, same company has taken 10,000 ordinary shares from you, and they have given you new 20,000 ordinary shares. They might also give you preference shares. They might also give you cash as well. But the company remains same. If the transaction is similar, company remains same, then it is reorganization. But tax implication, either it is reorganization or takeover, they are exactly the same. Okay. What is Angus total number of qualifying months of occupation for private residence relief on the sale of house? Wow, wow, wow. Student, if you recall, the concept of principal private residence relief. Actually, in case of your main residence, if your ownership period and occupation period both are equal, then the entire gain becomes exempt. Repeat. If your ownership period and occupation period both are equal, then on the disposal of your main residence, the entire gain becomes exempt. There's a possibility that occupation months are less than the ownership month. In that case, there will be a chargeable gain, number one. Number two, you should be able to first calculate the occupation months. Basically, there are two types of occupations. One is actual occupation, which is very simple. Owner lives in that accommodation, so obviously it's an actual accommodation. The main, I would say, area is the deem occupation. Means owner does not live in that accommodation during the deem occupation period, but we assume that owner lives there. What are the points which actually they fall in deem occupation? Number one is absent for 3 years due to any reason. There's a possibility Mr. Y was living in his house then he left the house, maybe he travels the world for 2 years, 2.5 years, then he reoccupies the house. So if someone is absent for up to 3 years, then that time period is considered as that person was at home. Second, you are spending any time period while working abroad, that is also a part of democcupation. There's one more point. While working in UK and you're not coming to home, let's say for 4 years, that time period is also considered as a part of democcupation. But a very important concept is when someone has left the home due to any reason, or someone is working abroad, or someone is unable to is not coming home for 2 years, 3 years, even he is working in UK. The main concept is democcupation for these points will only apply when it is preceded and followed by actual occupation. And this last point also, the last 9 months of the ownerships are always considered as occupation months irrespective of any condition. Repeat, last 9 months of the ownership are always given to you as default exempt months. Let's see. Now, what we need to calculate? What is August's total number of qualifying months of, okay, we need to calculate months of occupation. Means actual plus deem, okay? 31st March 26, Angus sold a house which he bought it on day of purchase. Angus occupied the house, his main residence till this. So can I say actual occupation? From 31st March 12 till 31st March 2027. We can see that actual occupation, okay? This is actual occupation. If you see the difference, it is exactly 5 years. 5 year means 60 months. Okay, when he left employed abroad, Angus returned to the UK on 1st April 19. Now listen. From 1st April 2017 till I would say 31st March 2019. That is employed overseas. So that is a part of democcupation. Employed overseas. So let's see the time period. It's exactly 2 years. 2 years means 24 months. Then he lives in the accommodation till March 2020. Means from 1st April 19. Actual occupation 1 year means 12 months. After that, what is happening? When he bought a flat in neighboring town and made this private residence, neighboring town and made that his main residence, or he changed the main residence. It means he never came back. Now listen, students, we have already discussed one thing. The last 9 months of the ownership are always considered as exempt months. So last 9 months are always considered as occupation months. So these are the exempt months, or they are, you can say they are, these are the 60 plus 24 plus 12 plus 9. These are the occupation months, 105. I would consider this is a very good question. Obviously, a well prepared student could have answered, otherwise, it's not so easy to find out all these months. Okay, what is her chargeable gain assuming she claims all available relief? Okay, Masuma sold her only home, realize a gain before relief is 1,20,000. So she's having a chargeable gain. Chargeable gain, she's having 1,20,000. She had used 6 out of 10 rooms herself, let out other 4 for the duration of her ownership. Logically, 60% of the property was occupied by the owner, 40% was given to the tenant. It means that she will not only get the principal private relief, she will also get the letting relief, because the concept of getting the letting relief is when one portion is occupied by the landlord, another portion is actually given on, I would say, letting. Only then you get the letting relief. And letting relief, student, if you recall, is the lowest of, equal to the gain amount. It is equal to, I would say, PPR. Second, 40,000 pound, and the last one is gain on letting. Repeat. The maximum letting relief is the lowest of 3 values. One is 40,000 pound, which is fixed. Second is the principal private residence relief amount, and the second is the gain, which relates to letting period. So first of all, there are 10 rooms, 6 they were occupied by the owner. So simply principal residence relief is 60%. 72,000. Now we are having 48,000. Now letting relief is the lowest of. Letting relief is lowest of. Number one is 40,000 pound. Number two is principal residence relief, which we have taken 72,000. And third is gain relating to letting period. Now listen. There are 10 rooms in the property, 6 were utilized by the owner, 4 they were given on rent, which means the chargeable gain is 120. Out of this, 4 upon 10 actually belongs to the letting, which is 48,000. So the maximum relief which she can get is 40, because the letting relief is the lowest of all these 3 values. So letting relief is 40. So the chargeable gain is 8,000. Let's see what is the chargeable gain assuming all the relief. So after all the relief, the chargeable gain is 8. Okay. Now let's try this. The disposal of which two of the following assets qualify for rollover relief? Student, disposal of which two of the following assets qualify for rollover relief? Let's see. A portable, no. Actually, portable swing machine cannot qualify for rollover relief because we need fixed, we don't need portable. The disposal of which two of the following qualify for rollover relief? Shares in an individual personal trading company, they don't go for rollover relief. They will go for better. Okay, land used by a sole trader in the business, yes, that goes for a rollover relief. Shares in a company of which individual is an employee, no. A building owned by a company let out other businesses. Technically, it's not a business asset, it's an investment asset. And in fact, when you are selling shares, they are not qualifying for rollover relief. They are your business assets. The goodwill in a sole trader business, yes. So logically, C and F. But let me tell you one thing. While sitting in exam, if a student, any one of us makes mistake in this, one or two multiple choice question, if they go wrong, kindly do not go into a panic condition. You still have enough questions to pass the paper. Let's see this one. What is the base cost of replacement warehouse for capital gains tax purposes? What is the base cost of the replacement warehouse for capital gain tax purposes? Alice is in business as a sole trader. On 13 May 2025, she sold a freehold warehouse for 1,84,000, and this resulted in a chargeable gain of 38,600. Alice purchased a replacement freehold warehouse on 20 May 2025 for 143. Now stop. It's a partial reinvestment case, students. Why there's a partial reinvestment case? If you look at the question nicely. So what is actually happening here? Alice is in a business, sole trader, sold a freehold warehouse, sold it for 184, but purchase is for 143. Are you getting this point, students? It means the entire sale proceed was not reinvested. Okay, where possible, Alice always makes a claim rollover relief gain against the cost of replacement asset. Both building have been or will be used for the purpose of business. What is the base cost of replacement warehouse for the capital gain tax purposes? Okay, let's see. Student, partial reinvestment, if you recall, I think we have discussed already. Partial reinvestment says chargeable gain is lower of gain itself. Gain is 38,600 and the second is amount not invested. Amount not invested. Alice sold it for 184, bought it for 143. How much Alice did not invest? 41,000. So can I say logically the entire 38,600 becomes the chargeable gain. If the entire 38,600 becomes a chargeable gain, logically Alice is not getting any rollover relief. What I want to say, look at this. Gain is 38,600. Logically, the same gain is your chargeable gain. There is nothing for the rollover relief. This entire 38,600 is your chargeable gain, which means that there's nothing to be rolled over. Because if we had any gain left, we would have deducted that gain from the cost of the new replacement asset. So logically, we have nothing for the rollover relief because the entire gain is a chargeable gain, which means that base cost of the replacement warehouse will remain equal to the cost of purchase, which is 143. Repeat, we have done in the same class where you have seen there was a partial reinvestment case, and from the gain when we deducted a chargeable gain, we had a little bit rolled over relief or deferred relief. Here the problem is entire gain becomes a chargeable gain. There's no rollover relief, there's no deferred gain. That is why we have nothing to deduct from the cost of the replacement warehouse. So that is why the entire 143 is the base cost. Okay. What is the chargeable gain arising on the disposal of warehouse in December 25? Assuming all available reliefs are claimed. What is the chargeable gain arising on the disposal of the warehouse in December 2025? Assuming all available reliefs are claimed. In October 2025, it is sold a factory for 2,30,574, realize a gain 31,083. In May 15, he bought a warehouse. So student, you can see one thing. Replacement asset cost is more than the sale proceed. In that case, the entire gain becomes a deferred gain or rollover relief. He then sold the warehouse for this. Now listen. Disposal proceed is 270,213. But when we bought this replacement asset for 2,31,211, replacement asset cost is more than the disposal proceed of the previous factory, which means that entire gain is your rollover relief. So the base cost of the factory is 2,31,211 minus 31,083. Oh, 2,31,211 minus 31,083. Logically, the base cost I'm getting is difference of these two, 2,00128. That gives us the chargeable gain, 2,70213. Students, the chargeable gain is 70085. Wow. Okay. Now let's do this. Which of the following statement is true? Fine, let's read first. Daniel has had a 30% shares in manufacturing partnership since 2019. He intends to dispose of his entire interest in a partnership in the tax at 25-26 by selling it to his son for less than its market value. This is the first situation. Daniel has also been a director and 10% shareholder in an unquoted investment company. This, he has decided to gift his shares to his daughter. That's the second scenario. Let me tell you, students. You are having Daniel is a director and 10% shareholder in an unquoted investment company. It's not a trading company, okay? Let's see. Gift holder relief. Actually, all the reliefs are available on business assets. Gift holder relief is available on the disposal of interest in the partnership, but not on the share. That's true, 100%. Why it is true? Basically, when you are having holding in an investment company, it is not treated as a business asset. And all the reliefs actually they are available on business assets. What else? Gift holder relief is available on the disposal of shares. No, false. Gift holder relief is available on both. Investment asset. Investment asset you cannot get gift relief. Gift holder relief is available. That is also only A is the true one. Let's see. Select the individual that appropriately fill the gap above. Okay. The four shareholders of Elephant Limited are selling their shares. They own the share capital as follows. MN is having 32%, Amin is having 32%, Ben 32, Camellia 32, that becomes 96, Dimitri 4%. Okay. All shares have equal voting rights. Amin has never worked for the company. If you have never worked for the company, then it cannot be your personal trading company. Ben works part-time, either you work part-time, full-time, it can be your personal trading company. If your holding is at least 5%, ownership period has to be at least 2 years. Camellia and Demerity. Demerity cannot is having 4% holding, so the company cannot be a personal trading company. Work full-time for the company. Camellia only joined Elephant Limited 6 months ago. Has owned her shares for 3 months. Whereas Ben and Demerit have worked for the company, owned their shares for 5 years. Only Dash will qualify for bidder. Only Ben actually qualifies for. Actually, for Ben, it is a personal trading company. Nothing, not for others. Only for Ben. Okay, let's do this. What is the amount of gift holder relief, if any, which could be claimed in respect of the disposal of these shares? Okay. Anika sold her entire holding of 3,001 pound shares to Distribo Limited, a trading company, to her son, Hemi, for 53,000. On 14 July 2025, the market value of the shares was 98. We know that when you are selling to a connected person, we take market value as sale proceed. So sale proceed we assume is the market value, which is 98,000, and they were purchased it for 41,500, so the cost is 41,500. Here comes the gain, but there's only one issue. Let me calculate the gain. 98,000 minus 41,500. The gain amount is 56,500. Now listen. Actually, Anika has taken consideration 53,000 from her son, which is more than the original cost. Now listen. When donor takes the consideration and that consideration is more than the original cost, it is happening here. The consideration taken by the donor is 53, which is more than the original cost. This difference becomes your chargeable gain. That will actually reduce the amount of gift holdover relief. Repeat. Whenever consideration taken by a donor, obviously from the donee, is more than the original cost, difference is the chargeable gain. So 53,000 minus 41,500. Logically, the chargeable gain is 11,500. Student, if the chargeable gain is 11,500, so difference is going to be your maximum gift holdover relief. So maximum gift holdover relief is 45,000. 45,000 is the gift holdover relief. The rule is, if donor has taken the consideration from the donee more than the original cost, if donor has taken the consideration from the donee more than the cost, difference is the chargeable gain. And that chargeable gain actually reduces gift holdover relief and the amount of gift holdover relief, which is this. So students, that was a quick, I would say, revision on chargeable capital gain on we deal in chargeable gain with individuals. So we covered many areas of capital gain. We also discussed a new area of taxation today. Plus we did a 115 marks question also. And from the next class onwards, obviously, we will be doing a revision on again on all these areas. Plus now from the next class onwards, I will try to incorporate corporation tax as well. Corporation tax videos, I think maximum by today, otherwise by tomorrow, they will be uploaded on the portal. So thank you very much, students, that you people have taken out time for today's class, and you might have noticed that, as I mentioned earlier as well, that slowly and gradually the live revision classes, they will get longer and longer. The duration will increase. They will remain the same one day in a week, but duration will increase. If needed, then obviously we can increase the frequency as well. So thank you very much. Do give the feedback on today's class in your relevant WhatsApp groups. Thank you very much.